Hey everyone, in this week's episode, I'm going to talk about different financial calculations which you need to be aware of when you start looking at real estate investing. Now, why is this important? This is important because when you're looking at different types of investments, you might want to compare what is the return on investment for each type of investment which you might want to do. Now, you could be looking at stocks, you could be looking at bonds, you could also be looking at mutual funds. And at the same time, when you start looking at different real estate assets, you might want to compare one real estate investment with another. So you could say, should I buy this single family home and invest in this one, or should I buy another single family home and invest in that one? Now, you want to make sure you're not making an emotional decision. So you're making something which is a data-backed decision and something which you're doing it more on a quantitative basis. Like you go and run the numbers and then you know which is a good investment for you. So how do you get started in understanding all the different financial calculations? Now, you must have heard things like return on investment, return on equity, cash flow, cash on cash return, net operating income, IRR, cap rate, and so on. There are so many such investment calculations out there and investment metrics that you might get very overwhelmed with it. So what we want to do is understand this in a very step-by-step way. And today what we're going to do is just understand the cash flow side of things. Now, as I said before, cash flow is the lifeblood of your business. You already want to make sure that whatever happens, you have a positive cash flow and that fuels your business and you go through the day-to-day operations using the cash flow. So how do you calculate cash flow? It's pretty simple. What cash flow is that you look at all your revenues and then you deduct all your expenses from it. What is left is the cash flow for you. Okay, so let's take one step at a time. So what are the revenues you get? A major part of your revenue is going to be from the rent you receive for the unit you have. Okay, so you can get a rental income, monthly rental income of $1,000 per unit or per house which you have. Okay, so that is your first aspect of it. That's the first line you write. Okay, this is my rental income. This is what my revenue is. Now you go and say, okay, am I doing anything else besides just renting this unit? Am I also getting some residual or some additional income if I'm renting out a garage, for instance? Or is there any other way I'm making some more money? And all of these things then again become part of your revenues. One aspect which you also need to take care when you look at cash flow is you also look at something called as the vacancy rate. Now, what is the vacancy rate? It's a percentage, which basically says that over a given period of time in this location, in this area, there is a 3% to 5% vacancy, which can happen. What that entails is that you may not get all the revenues in that year. There could be a period of time where you could be hit by vacancy between changing tenants, or it might take some time for your house to turn and marketing to happen and the new tenant to come in. So you should always deduct your vacancy rate from your gross revenues which are there. So that's the first thing you do. You find out your gross revenue, you take the vacancy rate. Could be anything, 3%, 5%. You find it out from the market, you find it online, and you can say, okay, what is the vacancy rate in Mason, Ohio? What is the vacancy rate in Cincinnati, Ohio? And then you take I would say a conservative number. Don't be very optimistic and say, yeah, I will never have any vacancy, or my vacancy rate is only going to be 1%. So always go with a little higher vacancy rate so it buffers you from it. So now you have your revenue side of things already completed. You took your total revenues, you deducted your vacancy rate, and now you have your gross revenues. Now we turn our attention to the expenses side of it. So first we'll start with the operating expenses. So what are operating expenses? Your operating expenses are your day-to-day expenses which you have in running your business. So it could be your property taxes you pay, the mortgage you might have, the insurance which you buy, the money you pay for someone to mow the lawn, the money you pay for someone to clear off the snow, and so on. So all your expenses which you incur for running the day-to-day operations fall under that one single bucket called as an operating expense. Now, once you take out the operating expenses, what is left is a net operating income. Now, this is very important. Now, I mentioned something called as like you might have expenses for debt services, like you're paying your mortgage. You would not take that out from your operating expense. You would take it out after you have a net operating income. And the reason is you might have instances where you're buying an asset full and clear using cash. So when you're using cash, your net operating income will not have the debt side of things. So that's why, and this net operating income is a very important concept when we talk about cap rate. So right now, just keep one thing in mind. You have your operating income, your revenues, you deduct your operating expenses, and whatever is left is your net operating income. So that is one aspect of the calculation. Now you start taking your debt services here, and now you start looking at what is my debt services. So it could be when you took a loan, what is my interest, what is my principal, and what is the monthly payment I'm making out of it. So that is part of financial expenses, and you deduct that from that net operating income which you have. You would also deduct any PMI which you might be paying. That is, if you've not made 20-25% down payment, banks sometimes require you to take like a kind of think of it as a mortgage insurance, and you pay like $25-50 or something around that per month as part of securing the loan which you have. So that also becomes part of your debt services, and you reduce that from your net operating income. So once you take all those things, what is left after that is your cash flow. Now, one other thing which you can or cannot remove or may not remove is going to be your capital reserves. And this becomes a very contested topic. Like some people like to take the capital reserves and reduce it. Some people don't. I prefer taking a capital reserves and reducing it, because what it does, it brings you a very conservative cash flow. So if anything goes wrong, you have a capital expense. Your capital reserve is helping you because that money is now part of your cash flow and you kept it on the side. Okay, and a capital reserve is, you can say 3% to 5% or 10%, depending on the age of the house or the age of the real estate property you have, is going to be put aside for capital expenditure which can happen in the future. So reserves is just something as you taking some money out of your income and you basically keeping it on the side. In case something goes wrong, you have a bundle of money which you can use to fix those capital expenses. Now, finally, after take out all of those things, you are left with a cash flow. And that is your pure cash flow, which you're going to use as you go forward. Remember, you want to make sure your cash flow is positive. So when you take all the income and you reduce all the expenses, what is left is going to be your cash flow. And that is the cash flow, which is what you should be looking at. And many investors have certain cash flow targets too. So they might have a cash flow target of, I want to make sure I have $200 per door. So if I have a multifamily and I have like 4 doors or 20 doors, I want to make sure I have $200 in cash flow every month from a door, from every door which I have. So that way you could have your own target. You can say, I want to make sure my pure cash flow at the end of the month is $500 per unit. And very quickly, if you have that kind of goals, very quickly as you start underwriting and going through different properties, you can remove the properties which do not even meet that goal for you. So that way you are using a cash flow to basically determine whether this is a good investment for you or not. Okay, so this was your first episode in the series of different financial calculation episodes which I'm going to have. So hope this helps you. Hope you understand that cash flow is the most important part of it, and the calculation used for cash flow is equally important. Remember, be conservative and make sure you end up with a positive cash flow. Thank you so much for tuning in, and I'll have some more details on more financial calculation next week too. Thank you. Bye.